Welcome to This Explainer. Today, we are diving straight into the ultimate financial showdown, physical real estate versus the stock market. Now, you've probably noticed both sides have incredibly loud, super passionate advocates, right? Well, we are skipping all the opinions today. Instead, we're going to map out the cold, hard dollars, the time commitment, and the stress costs over a full 20-year investing journey to see which path actually builds more wealth. So who's actually going to be richer in 20 years? The landlord or the index fund investor? Let's get past the flashy YouTube thumbnails and focus entirely on the hard data. I mean, we hear it all the time, don't we? Real estate creates the most millionaires, or the stock market is the ultimate passive wealth engine. But what really happens when you put these two head-to-head in the real world? Let's find out. To make this a perfectly fair fight, our two investors, let's call them Jake and Marcus, are starting from the exact same financial baseline. They both have 50 grand saved up in the bank. They both earn $55,000 a year. They're the same age, living in the exact same city. Literally identical starting points. The only difference in their entire lives is what they decide to do with that $50,000. Day one, their paths split. Jake takes his 50 grand and uses it as a 20% down payment on a modest $250,000 three-bedroom rental property, locking in a 30-year mortgage at 7% interest. Marcus, he goes the boring route. He takes his 50 grand, drops it into a total stock market index fund, and sets up an automatic monthly contribution of $300. Right off the bat, Jake feels like an absolute genius. He's got a physical asset, he's got a tenant. Marcus just has a boring automated confirmation email sitting in a spam folder. But as we're about to see, feelings and math are two very, very different things. Okay, this is what I like to call the great illusion of cash flow. Jake finds a tenant paying $1,800 a month. Since his mortgage is about $1,330, on paper, Jake is making $470 a month in pure profit. Sounds amazing, right? It looks incredible on a napkin. But spoiler alert, that rent check is about to get eaten alive before Jake gets to keep a dime of it. Because man, reality hits hard by year 3. Jake has collected a handsome $64,800 in gross rent. Wow. But wait, let's look at the hidden drains. Once you subtract $3 grand a year for property taxes, insurance, a $1,200 replaced water heater, a $2,800 leaking roof, and the cost of just one single month of the property sitting vacant, Jake's impressive cash flow just completely evaporates. He's left with just a few $1,000s of actual net profit over 3 entire years. 0. That is the exact number of hours Marcus spent managing his portfolio. No 2 a.m. plumbing emergencies, no angry tenant phone calls. While Jake was essentially working an unpaid part-time job as a landlord, Marcus just let his money sit there. By year 3, thanks to those $300 monthly additions and just average market returns, Marcus's balance has quietly grown to about $76,000. Now, to be fair, Jake does have a massive, massive advantage that stock investors just can't easily replicate: the power of leverage. Because Jake used his $50,000 to control a $250,000 asset, when that property appreciates by just 3 to 4% a year, his gains are calculated on the full $250,000 value, not just his down payment. So his equity, his true wealth in the property, is actually growing rapidly using the bank's money. This 5-to-1 leverage, it's the #1 reason real estate creates so many millionaires. But as Jake is figuring out by year 5, controlling a massive physical asset means paying for massive physical problems. It really does turn into an unpaid part-time job. A solid rule of thumb is budgeting 1 to 2% of the property's value every single year just for maintenance. That's thousands of dollars. Roofs eventually need replacing, which is like $8,500. And surprise hits, like a $7,000 HVAC failure in the dead of August, yeah, that wipes out your profits instantly. And if Jake decides, you know what, I've had enough, and hires a property manager, boom, another 8 to 10% of his gross rent vanishes right off the top. Meanwhile, Marcus is relying on a completely different wealth engine. His wealth grows kind of slowly at first, but soon the compound growth begins generating more new wealth than his original contributions. Compounding is super boring for the first 5 years, but it is absolutely astonishing for the next 15. Marcus isn't picking stocks. He isn't trying to time the market. He is literally just sitting back and riding the accelerating curve of compound growth. So, looking at our 20-year scoreboard here, we've got year 1, the initial investments, year 5, the reality check, year 10, the close race, and year 20, the final reveal. Let's see how this all shakes out. 10 years in, and believe it or not, they are incredibly neck and neck in total equity. Jake's equity sits somewhere between $170,000 and $184,000, while Marcus is hovering right there between $165,000 and $180,000. But think about the risk profile. Jake has taken on hundreds of thousands of dollars in debt and concentrated all his financial risk into a single building in a single zip code. Plus, he's put in 20 to 35 grand out of pocket just to keep the place running. Marcus, on the other hand, he's broadly diversified across thousands of global companies, and he has spent exactly 0 weekends fixing drywall. Fast forward to year 20, the big finish. And honestly, this is fascinating. Both of these guys end up with a net worth squarely in the $400,000 to $500,000 ballpark. But the journey they took to get there couldn't be more different. Jake's property is now worth around $500,000, and his mortgage is nearly paid off. Incredible! But his pure profit from cash flow, after 2 decades of repairs and taxes, is only about 40 to 80 grand. Marcus's original $50,000, it's grown to roughly $440,000, with over $300,000 of that being pure compounding growth. The absolutely crucial point here is that this isn't just about financial returns. It is a profound trade-off between return on investment and return on your personal energy. Jake actively worked for his wealth. He dealt with the stress of bad tenants, late-night phone calls, and property illiquidity. Marcus? He just waited for his wealth. He had 0 debt, 0 tenants, and total ultimate freedom. And honestly, the math goes totally crazy if we just tweak the inputs a little bit. Adding a few extra bucks to an index fund is literally effortless, right? But scaling real estate requires exponentially more labor and debt. If Marcus simply bumps his monthly contribution from $300 to $500, his 20-year portfolio skyrockets to as much as $600,000, all thanks to the multiplier effect of compounding. But for Jake to increase his wealth generation, he can't just click a button on an app. He has to go out, take on another massive mortgage, buy a second property, and completely double his part-time workload. Now, to keep this totally objective, we've got to talk about the dark side of Marcus's path. It is terrifying in its own way. It requires an absolute iron stomach to survive gut-wrenching market crashes without panic selling. I mean, in 2008, the market dropped 37%. In March 2020, it dropped 34% in a single month. Watching your screen flash from 150 grand down to 95,000 takes a massive psychological toll. That's exactly where most regular investors panic and lock in their losses. Plus, unlike real estate, there is virtually 0 cash flow. A $150,000 index fund portfolio might only yield about $200 a month in dividends. That's not replacing anyone's day job. On the flip side, real estate is not inherently a bad investment at all. In fact, it can completely crush stocks if you leverage specific strategies. If you're in a market with strong rent-to-price ratios, like pulling in 0.8 to 1% monthly, the cash flow math absolutely works out. If you use strategies like house hacking, where you live in one unit and rent out the others, you can drop your personal housing costs to near 0. And if you use legal tools like 1031 exchanges, which let you roll profits from one property directly into a new one tax-free, and treat it like a strict business, real estate yields returns the stock market just literally can't touch. So what's the real trap here? The trap is picking a side based on some viral video without ever running the full numbers for yourself. Ultimately, both Jake and Marcus were kind of wrong because they fell in love with a narrative rather than mapping out the actual dollars, the time, and the stress over 2 decades. Real estate is a vastly misunderstood investment. It's not a guaranteed magical path to riches. And stocks, they're a phenomenal compounding engine, but they come with massive emotional volatility. So the next time someone promises you that one path is universally better than the other, I want you to ask yourself this. Did they count the hours, the sweat, and the mental toll? When you look at your own future, are you looking for a second job or are you looking for freedom? Did you include everything? Because honestly, the answer that includes everything is the only answer that matters.